Hello and welcome back. We are going to continue our story about the standards and the way that they can be tested in SBR. My name is Lily Kirilenko and I am a tutor for SBR for over a decade. I had experience being an auditor in a Big Four company, a CFO of a big manufacturing company. I worked as a financial consultant, so I know how it works in real life as well. And as for IAS 36, impairment of assets, this is the most judgment-heavy standard. And as such, we do expect it to be tested quite often. Sometimes it will be a question that will be devoted to the standard, and sometimes the standard is going to sneak into your answer. Now, what does our examiner want? They want you to apply your professional skepticism. Not just to do what you are told, but to notice that this is when we open the book and apply IAS 36. Consider this. Imagine that we have a company that produces electric scooters. And because there is a new law and there will be the scooters are going to be banned, we expect that there will be reduced sales of them. So this is an impairment indicator. And an impairment indicator says that now we need to test the asset. Maybe the economic benefits that it's going to bring are going to be reduced. So this means that we will have to explain why there will be a trigger for impairment. And we can't just say, oh, because there is a new law. No, you need to explain the logic, the mechanism, so that even if you talk to people that have no idea about how IFRS works, they will still understand you and they will trust your approach. So we will need to say that as the new law is banning the use of scooters, let's say, on pavements, then it is expected that demand is going to reduce. This means that profit that this patent would generate would reduce as well, so the asset won't bring as much economic benefits as expected. So we may be tested on the triggers of the impairment. We also may be asked to calculate or to discuss the calculation of the recoverable amount. We do remember that the recoverable amount is the higher of fair value less cost to sell and value in use. But the measurement of that value in use, that is something that may be not really appropriate. So, for example, what is the discount rate that is used? Is this the one that would be applicable to this very project? Or another case, imagine that the management calculated the recoverable amount on the manufacturing plant based on future expected cash flows that take a product that hasn't been launched yet. We would say, no. The value in use must reflect the assets in their current condition and location. So if that is not an asset yet, if we don't have this license, this patent, whatever, for a new product, then we can't take it into account. We calculate value in use based on the information that we have, based on the assets that we have. And yes, it can be that, let's say, a month is going to pass and the patent is going to be registered and this plant indeed will be used to produce this new product. So the value in use of the plant is going to increase. Well, in this very case, in this next period, we would reassess value in use and maybe we will have to reduce the impairment. So we will have to credit it. There will be reduction in impairment. So once again, when value in use is calculated, we take the current state of assets. We take the discount rates that would represent the project and the risk of the project. As for the fair value less cost to sell, we would need to rely on IFRS 13, and as such, we would need to know what this standard tells us. So not the market where we operate, but the primary market for the asset. And as such, we need to challenge the calculations that were made by the management. Another thing that can be tested is cash generated unit and goodwill allocation. When we're going to test assets for impairment, we need to be able to calculate value in use. But some of the assets don't bring any cash, like goodwill. And as such, we would need to find this minimum cash generating unit, so this minimum pack of assets that would generate cash. And we would need to think about how goodwill will be allocated. And as such, it could be that this brand, let's say, would relate to 3 divisions. What would be the allocation basis? Is this consistent or not? Also, after we have identified the impairment, the allocation of impairment will be important. So we do remember that first we're going to allocate to goodwill, then to other assets on a pro rata basis. Those people that know something about IFRS already, you may remember that when we're talking about goodwill impairment, there are actually tricks around it. We're going to talk about it in later podcasts, but I would remind you that the process is going to be very different depending on whether you have originally calculated NCI at fair value or at fair value of net assets. Another thing is the reversal of the impairment. So we would need to assess whether the reversal can happen or not. It can never happen for goodwill. And as such, we need to explain, we need to clearly state that goodwill can't be, the impairment for goodwill cannot be reversed because it's not that goodwill, it's newly generated goodwill. We are going to talk about the disclosures, about the judgment, about the transparency, because these major circumstances related to the impairment have to be disclosed. So, IAS 36 is an important standard. It will be tested very often. Not very often we will be asked to actually do some calculations. Most often we will be asked to talk. And even more often, there will be no indication that you need to apply IAS 36. You just need to guess from the context. I hope that this was helpful. I would remind you that this is just a summary just for you to understand the concept, but it's in no case a substitute of the fine and fantastic lectures that we have. And I will see you next to talk about the next standard that you are studying.